Welcome to Dads and Dollars podcast with your host, Stanley Funches, certified financial planner, business owner, author, speaker, and father of three. Listen as Stanley shares his valuable insights around fatherhood and finances gained from over 20 plus years of experience. You'll hear stories, lessons learned, and the ups and downs he and his guests have encountered on their journeys as fathers, professionals, and business owners. These shared lessons will help provide you a path for financial independence while celebrating the challenges of being a dad. Thank you for joining the conversation. Here's your host, Stanley Funches.
Good day. Welcome to Dads and Dollars, the podcast where fatherhood and finances are woven into everyday life topics. My name is Stanley Funches. I'm a certified financial planner by profession, a father of three in this thing called life. We're glad you can join us for season 1, episode 10. And in episode 10, we're going to talk about the Biden-Harris Student Loan Debt Relief Program. We're going to get into some good stuff here beyond the headlines. And we're going to wrap up by answering some of your questions. So let's dig in. All right, so as we talked about, we're going to go beyond the headlines. We know that Biden campaigned on student loan forgiveness is one of those topics that they had on the campaign trail. And we're not going to get into all the politics and the right or wrong, whatever, about student loan forgiveness. We're just going to talk about the facts. This will impact a number of people throughout the country. 43 million people have student loans. So it's a big issue when it comes to the number of people within the country that have it. And I personally was impacted by this as well. Many of you know, just by listening to the podcast, I went to Tulane University in New Orleans, and I don't know if you know about the cost structure there, but it's a very expensive school. And when I went to school there, did pretty well in high school, got scholarships and whatnot. My parents and I, we didn't understand the full what it took to go to school and how the financial package worked. What we later found out at registration was, hey, we were getting this little line item called student loan, and it was going to help take care of some of the room and board. The scholarships I had took care of tuition, books, fees, and all those things. But part of the room and board we had to cover, and I covered that through a student loan. So we didn't know what impact this would have for us after college. And it's one of those things that probably a lot of people who are first generation, 4-year college just don't completely understand that, hey, your financial aid package may have scholarships in it as well, but you may have to cover some of that yourself through work study or student loans. And those are the things that I did. So I definitely have some sympathy and empathize with people who have student loans and dealing with the struggles of when you get out of school and you're trying to develop your career or your business and you're having to pay those back as well. So, and also have experience with current clients who have student loans. I have most of my clients are business owners, physicians, pharmacists, dentists. So they've gone to school for a number of years. And I have seen clients come in with $400,000, $300,000 of student loan debt. Now, those clients can, once they get done with their education, they can go out and command $250,000 to $500,000, sometimes more than that in income. But yet and still, having $400,000 student debt is not a great place to start. I mean, so, and it's not a good feeling, and it's a large income outlay every month to pay down that debt. Now, we're not going to argue whether it's worth it or not, but it's the existence that they have to live, and they are starting with their net worth again, because most of those clients that I have are more first generation or just starting to build wealth themselves, and they're starting out $400,000 in the hole in negative net worth. So now this Biden-Harris student loan debt relief program does not speak to those clients who make those income levels. It speaks to, I think that this program, what they're doing is trying to speak to maybe the nurses, the teachers, the construction workers, people who people who went to community colleges and maybe went 2 years and developed a trade, uh, they have more modest income levels, and maybe 60 to 80, $70,000 a year, maybe trying to raise their family, and they're being burdened by payments. And so I think that this Biden Harris student loan debt relief program is trying to speak to that demographic. So what we're going to go over is not going to be an exhaustive list. So I encourage you to dig in some more to some of these things. If anything kind of seems like it applies to you or somebody you love, dig in a little bit more to get the answers for yourself. Again, this impacts 43 million students, borrowers throughout the student loan borrowers throughout the U.S. So if this doesn't impact you, I'm sure you're going to have a friend or a loved one that you can probably share the information or share the podcast with, and so that they can get something from it and get some action items from it. And lastly, many of the fine print details for this they're not out yet. This was not passed through Congress, so it's not a piece of legislation. It's an executive order. It's something that the president and his staff came up with, and it's going through the Department of Education. So it's an executive order. So that means that some of the things will be developed and they're working on. So you'll hear me say that, hey, we don't have clarity on this just yet, but they're working on getting us clarity on things. So just kind of a few housekeeping things before we get started. If we can remember, I think, well, on the campaign trail, they were talking about, hey, up to $50,000 of original proposal for forgiveness. And so this plan that we're looking at now does not have $50,000. So you've probably seen the headlines. The amount of forgiveness on the student loans is, $10,000 for taxpayers who income are below, if you're single, 125,000, and if you're married and you have a joint tax return, it's 250,000. All right. But if we go a little bit beyond the headlines, that number actually could be $20,000 of forgiveness that can happen. So if if a student loan borrower, when they went to college in undergrad, if they received a Pell Grant, now a Pell Grant is usually given out to low income students. So parents are considered low income. And so you can get a Pell Grant to help subsidize some of the cost of that financial institution if your parent income is below a certain level. So if those students at the time they went to school received a Pell Grant in their financial aid packet, then they will be eligible for $20,000 of forgiveness, not just the 10. So it's a very important thing to kind of look back, think back to your family status at the time, what financial status, and say, hey, look, I did receive a Pell Grant, and then you can confirm that on probably the application. Another thing kind of beyond the headlines is, we said 125,000 for a single filer, then 250,000 for a joint filer. Well, it's also a $250,000 limit for head of household, meaning that if you're a single parent and you have kids, or you're single and you're taking care of your parents as dependents, and you're the head of your household, then you get the $250,000 income limit. So if you have income less than $250,000, then you're eligible for this partial loan forgiveness or full loan forgiveness wherever you are in the balance. So just keep that in mind. So head of household is another thing that you can think about. So now these are going to apply for tax years 2020 and 2021. All right. So if you filed your taxes in 2020 or in 2021 and your incomes were below those thresholds, 125 or 250, depending if you held a household or joint, if in either year, so in either 2020 or 2021, it doesn't have to be both. If any one of those years you were below those thresholds, then you're eligible for loan forgiveness. Okay. Now, one of the things to go back to the tax filing status, we don't know, which is unclear right now, if you're married filing separately, what the income levels will be. We can pretty much guess though that those will be the 125,000 threshold. So if you're married filing separately, each spouse would have to have income less than 125,000 on their tax return. So and also we don't know exactly, is this adjusted gross income, or is it gross compensation? We're making the assumption based on how the federal government has defined income in other student loan programs. They typically define it on adjusted gross income. So that's a line item on your tax return, adjusted gross income. So you can go look at your 2020 and 2021 tax return now and see where you fall there. And again, this will apply for 2020 and 2021. So the type of loans that will be forgiven, what we call the Federal Family Education Loans, is FFEL. Now, these are federally backed loans. A lot of times they're funded by private companies. And so some are held by the government, by federal government, and some are held by private lenders. Right now, the way it's read and the way people are interpreting it is that the ones held by the federal government directly, those will be forgiven under this program. Those that are held by a private lender, is not very clear in the current writing of the executive order whether they will be taken into account. But there is a way to kind of get around that. It's what people suspect, and it might work, is that you can consolidate into a directly held federal government loan. You have until October 31st to do this. You can consolidate into this directly held federal loan by October 31st, and it will qualify you for forgiveness. Again, you can research this on your own, but that is, or at least watch out for it to see if there are any changes in the law. But that is the current way in which people are, if you have a privately held loan, that's the current way that everybody's looking at trying to qualify for this forgiveness. So another type of loan that's covered under here, that's again beyond the headlines, graduate loans and plus loans. So if you graduate school, you have graduate school loans, they still will qualify, but probably by your graduate school, it's probably not going to be looking at your parents' stuff. It's probably going to be looking at your income, because you're probably a graduate, you're probably working, you're probably not a dependent anymore. So think about that. But plus loans is what I want to focus on in this as well. So parent loans. So if you're a parent and you took out a loan for your child, then you can qualify for the $10,000 forgiveness under the plus loan program. All right. Now, if you had a Pell Grant, if your child got a Pell Grant, and they can apply for forgiveness on their own, so they can get, if they didn't have a Pell Grant, they can get $10,000 of forgiveness if they meet the income levels. If they did have a Pell Grant, then they get $20,000. So your family, you could get $10,000 forgiven on the plus side, and the child can get up to $20,000 depending on where you guys were Pell Grant wise. Again, everybody must meet the income threshold though. You must be below it in order to make that work. Another group that can qualify for this is current students. So current students are also allowed to seek forgiveness. So if I'm a current student and I had my loans funded before June 30th, then I can go seek forgiveness, even if I'm still enrolled in school now, on my loans that have already funded. Now, if they are a dependent, it's going to go back through the parents. It's going to look at the parents' income to see if they're below those thresholds. All right, so that goes back to the 125 and the 250 that we looked at. So if the child is dependent, if the child's not dependent, they'll look at their income and they could possibly get forgiveness too. Now, in everything that we look at, the forgiveness that will come, the 10,000 or 20,000, seems to be federally tax-free. So that when that balance is written off on the loan, which is very different than previous forgiving programs, you usually have to pay taxes on it. But this one tends to, what everybody, all the pundits are saying is that this is going to be tax-free. But the federally tax-free. Each state might be different though. So you'll need to look at your state and see if this is going to be tax-free with your state. So if you qualify for it, you get the forgiveness, check with your state to see if it's going to apply to you. Now, my last nugget about just the forgiveness portion, and again, I want you to follow it over the next few months to make sure that you can do this. But one of the strategies that during the pandemic, there was a freeze on payments, on student loan payments, on certain types of student loans and their payments. So if you qualified for the freeze, but you said, hey, you know what, it's 0 interest, I'm still going to pay anyway, so I can pay this thing down a lot quicker. Well, you can ask, depending on what your balance is, and you might want to talk to your advisor and see if this makes sense for you, but you can ask for all of that money back that you paid over the last 20 some odd months. You can ask for that money back. And so let's say your balance when we started before the pandemic was $23,000. So you had a $23,000 balance, but now because you made your payments, you only owe $5,000 left. Well, great. You can get forgiveness of that if you're meeting those income thresholds. But you can ask for, if your balance was 23 and you owe 5 now, that means you paid 18 in over the last couple of years when you didn't have to. You can ask for that 18 back. All right. Now, when you get that 18 back, your balance is going to go back up to 23,000. But guess what? You can apply for forgiveness now, and you're going to get either $10,000 or $20,000 forgiven, depending on where you match. Now, let's just say you get the $20,000 forgiven. Well, your balance went back to 23,000. You get 20,000 forgiven, and now you only owe $3,000, and you can pay that with the 18,000 that you got back, and now you have 15,000 in your banking account and your student loan forgiven. So, with the way we read everything now, that's a plausible strategy. Now, we don't know if they're going to close that loophole or anything like that, but you really think about that if you're qualifying for forgiveness and you've made payments throughout the time here, and your balance is such that you're below the threshold of forgiving, and you want to get your money back and maybe come out a little bit better. So again, talk to your advisor, do the numbers, see if that works for you. Again, tell other people about it. Keep abreast of any changes that they make, so they may close that loophole, but definitely think about that. All right. So one of the things with the whole theme of the Biden-Harris student loan debt relief program was just that, to give relief in the balances that may be in the account, hence the forgiving of the $10,000 or $20,000 amount of the balance of the student loan. But they also wanted to address some of the current programs where people are paying back money and they can have less payments and a short amount of time to pay these off. So they went into a couple of the main programs that people are using now to pay back student loans, and I'll go over that here. So one of those repayment plans is the income driven repayment plan, and that's IDR. And so and that's where you apply and say, okay, hey, this is how much income I'm making, and I'm going to apply because right now I'm not making very much income. I want to have an affordable payment, and as I make more income over time, my payments goes up. And then, if I make my steady payments for over 20 years, then the balance will be forgiven if there is a balance. But as my income rises, my payment rises. That's the crux of what the income-driven repayment plan is. So one of the things that they're doing, and if you're using the income-driven repayment plan, or anybody that you know is using it, they're trying to make sure that this is a more affordable plan, less cash draining plan for those people. Again, this is beyond the headlines. You don't see this part. What they want to do is they want to cap the amount of required payments under this source. Try to make it try to make it a simpler way of doing it. So 5% for undergraduate loans. So your income, if you got an undergraduate loan and whatever formula they have for your discretionary income, you can only have your payments can't exceed 5%. And it's 10% for a graduate school loan. So if I have a 5% undergraduate, if I had an undergraduate loan, I'm going to be at 5% cap of what I would have to pay. Okay. Or 10% of my graduate. And they'll blend them if you have a mixture of both. Now, to put that in context, because it's a formula, I'm not going to get into all of that, of what discretionary income is and everything, not yet. But just know that 5% for undergraduate loans and 10% for graduate loans is very different than what it used to be. It could have been as much as 20% under the previous, before this executive order was made. So they're really trying to cut down on how much people have to write a check and make it affordable for them to pay their loans on time and keep it up and everything. Now, after 10 years, if original balance was around $12,000, so if people borrowed money to go to a community college or whatever, and they borrowed $12,000 in their time, and if the balance was less than $12,000 after 10 years, they made those payments, then the rest of it would be forgiven. So that's again a way to make it affordable for the working family, but also make sure that they're not paying that loan in perpetuity. All right. So and so then another thing that they're doing too is within that formula is that discretionary income, they are raising that to be 225% of the poverty line. Where discretionary AGI minus 225% of the poverty line is what's building into that formula. Now, the way I'm going to explain this, because again, I can get into the weeds in it, but I'm not going to do that for you. Basically, if a family of four is making $61,875, because in 2022, the number is 27,500 for the poverty line. So if I take 225% of that, I get $61,875. So if a family of four is making $61,875, if it's a single mom or parent, co-parents, whatever, they're making that amount, then they are not, or less, they are not going to have to make payments in an income-driven repayment plan. Okay, so they sign up for the income-driven repayment plan. You make $61,800, then you're not going to have to make a payment. Now, when your income gets to a certain level, then you'll make payments. You used to have to recertify and provide documentations on a yearly basis of what your income is. Another thing that they're trying to enhance here is to take that burden off you, and where you can sign a piece of paperwork. U.S. Department of Education probably will go get your tax information. It is the government, so they should know it. They're going to go get your tax information if you sign off and say they can, and they're going to recertify you. So if that family's income stayed at that $61,000 level, and they basically stayed at 225% of the poverty line, then they won't make payments on their loan. But when they go over, then they have a payment schedule, just like we talked about, not to exceed 5% undergrad, 10% graduate. Okay, so that's in a nutshell. You can look at it a little bit further and research a little bit and dig a little bit deeper on that. And it's kind of up in the air. So this new income repayment plan, new kind of income-driven repayment plan, it's kind of up in the air whether people can switch or not. Again, keep your eye on it. If you're in a plan now, it doesn't seem like it works for you, then hopefully you'll be able to switch to this new plan. And here's the part about it I like the best about this income-driven repayment plan is that, so if I have an income-driven repayment plan and I'm making decent money, right? And so I'm not at the 225% of poverty line, I'm over it, and I'm making my payments. Well, I'm not making the payments on the amortization table that I should. I'm making less than payments than what I should. So let's just say my payment was $400 supposedly if I did a straight amortization, but I'm only paying 150. Well, that's $250 that I'm not paying, and that usually just kind of stays and we get added interest on it. So that interest is adding up more and more. So it's giving me a larger balance, and the interest is growing on top of interest. And so if I change my payment plan, or if something happened and I had to consolidate it somewhere else, then that interest becomes capitalized, meaning that it becomes part of my balance now. So if that interest becomes part of my balance, that means I've been on this payment plan, I've been paying on it, but I've been paying less because they're giving me a break and not an income I'm paying, but I'm still getting charged interest. Now this interest becomes a part of my balance, and that's compound interest working against you, and that's the silent killer that gets a lot of people, and makes those student loan balances get higher and higher. And so what they're doing in the new income driven repayment plan is that the government is going to subsidize all of that interest, where, okay, hey, yeah, I'm paying 150 instead of 400, and that extra interest, the government's coming in and subsidizing that interest payment. So that means that if we decided, if something had happened and you need to do something differently, that interest is not going to capitalize because it's already been subsidized and is not there. So I think that's a great little nuance in there that's going to help a lot of people who go through different life stages and have things happen, where they're just not forever burdened with a growing balance of student. You probably say, hey, well, Stanley, that amount's going to get forgiven anyway. But you just got to remember, when that amount is forgiven after 20 years of paying on it, if the interest is if the interest is capitalizing, that means my balance is so much larger, which means now I have to pay taxes on a larger balance. So I may have to pay taxes on twice as much as what I borrowed. I mean, we don't know the answer to that question, but yeah, it's going to be more if that interest is capitalized. So the subsidizing that interest helps relieve that for people. So that's the income driven repayment plan. The other plan that the government tried to touch is the public service loan forgiveness waiver. Okay, so if you work for a government entity or a nonprofit for 10 years, then you're eligible to get your public your loan forgiven because of your service in the public sector. So they wanted to address, and they have over the last year addressed some of the issues around that complexity of the public service loans. And again, not going to dive too much in it, but I'll just give you a couple of things to look at. So previously, if you have somebody who have been told, or if you know of someone who's been told, hey, your loan does not qualify, it's ineligible for a public service loan forgiveness, I would tell them to go back now and check, because it's allowing, this new rule is allowing some of those payments to now be considered as for to give you credit for that 10 years of service. If they told you your loan did and you were making your payments, that your loan wasn't eligible, you might be able to get some of those payment years back to go towards your 10 years. So that's one thing. Now, and then it used to be that if you made a lump sum payment, that wasn't eligible to count in your repayment, or your payment was late, then that didn't give you credit. Well, now they're saying, hey, you made those payments, you get credit for it. And they may say that you may have ran against, well, you're in a ineligible repayment plan, so you can't have public service loan forgiveness because you're in an ineligible repayment plan. Well, they're addressing that as well, and they're saying, hey, you made your payments, we want to make sure that you get your credit years so you can go back and get your credit years for that. So while you worked at the public sector, those technicalities they're trying to get rid of, whether they told you the loan, the FEL loan that you had was ineligible, whether they told you your payments you made, if you made lump sum or late payments, or if they said you were in an eligible repayment plan, now they're making that eligible for you. So definitely go and go to the website www.pslf.gov, and you can get more information. Now, there's a question whether October 31st, 2022 is the deadline. Some people seem to think that this executive order is pushing that deadline. I would tell you that if you're in that public service loan forgiveness area, then go to that website, call your service provider, try to make sure that you can get credit for any of these back years of public service loan forgiveness payments that you made that they told you might have been eligible for. All right, so those are the driven plans, and that's how the income driven plans as well as the public service loan forgiveness. So the Biden-Harris student relief is addressing those to try to make them easier, simpler, more accessible for people, and to try to lower the amount of money that people have to pay on a monthly basis to relieve that burden a little bit, as well as make it where they're not paying for their entire life on a student loan. So, all right, so you're probably saying, well, how do I apply for this? Well, the application hasn't released yet, but they have given us a website, and we're going to have that website in our show notes along with just the other PSFL website I just gave you. We're going to have those in our website so you can go. The website is https://studentaid.gov/debt-relief-announcement/. Again, it'll be in our show notes, but I thought I'd just tell you that. And so what you do is you just register there, and they will let you know when the student loan application for forgiveness is available. And hopefully, if you have income on file for income-driven plan, it'll make it relatively easy. I think you may not even have to fill out an application. They'll just go ahead and forgive it because they already have, whatever recertification you did on file. All right, so some of the things that you need to do and to think about is the payment freeze, which is another part of this executive order, will probably end December 31st, 2022. The order says December 31st, 2022. They keep extending it, but all the pundits and everything that I read say, hey, this is the last one. So December 31st, 2022. If you haven't been paying on your student loans, you're going to have to resume paying for them in January. So some of the things that you should do regarding the payment freeze is make sure that you budgeted for the payment to come back out again. So if things are kind of crowded into your budget, you might need to cut some stuff so you can make accommodations to now again resume paying your student loan. Check and make sure you got the proper bank account. I know people change bank accounts and everything. Make sure you have the proper ACH bank account on file online, so that you can get those dollars drafted out of the correct account. Make sure it's not an account that's closed or not. But a lot of service providers have changed on student loans. So what you want to make sure you do as well is go log in, make sure the service provider is still, like, you have active logins, make sure the service provider is still servicing it. If not, then find out who is, and make sure you sign up and have your enrollment for ACH set up. So that's one of the things you would do with the freeze here. A couple of other things that you need to do is, again, subscribe to get the notice that the application is available. Again, that'll be in our show notes. Go online or call your service provider to see what type of loan you have, to see if you have a FFEL that's held by the government or that is held privately. Because if it's held privately, you may have to do a strategy with consolidating, but that comes with a lot of different pros and cons. So again, talk to a financial advisor, sit down and figure out, hey, is consolidating this loan worth it? Is it in my best interest or not? So that you can possibly consolidate it into a direct loan held directly by the government, a FFEL direct. Make sure you get the right type of loan so that you can apply, so you can get some forgiveness. All right. So look into that, call your service provider, go online, see what type of account you have. Now, if you haven't filed your 2021 taxes yet, which, I mean, by October 15th, you have to, with extension. So if you haven't filed that, then maybe you go talk to your accountant and say, hey, should we file separately? Because one spouse, you know, you know, Jane may make $200,000 a year, but John makes 75. John's got $20,000 in student loan debt, but they did jointly. I think that takes them over 250. But if they file jointly, they might be over 250, whatever the numbers say, they get over 250. And so if John files separately, then he can, because he only makes 70 some odd thousand, he can get forgiveness on his student loan if he files separately. Now, again, that's for 2021. That's only if you haven't filed your taxes already and you meet the threshold. So it's just something that if it's worth you making a phone call to your accountant, a lot of people that may not even apply to, but is worth thinking about. And maybe it's just one person that we can help with that. Now, if you made payments during the pandemic, like we talked about, really consider if that makes sense for you to go back and ask for that payments back so you can get the full forgiveness on the dollars. It's still in the air whether they're going to close the loophole or not, but as of now, it's there. You got kids or grandkids in school, make sure you call them if they've gotten student loans. Say, hey, your mom and dad, they are less than 250, as far as gross income, you can apply for forgiveness. Or if they are on their own and not a dependent of anyone's, then they can apply for forgiveness if they're making less than 125. So just talk to your kids or grandkids about that, so they can get some of their current student loans, even if they're still in school and they had a couple of funded before June, they can get their student loans forgiven. Keep reading on and see if that strategy for the refunds will be a plausible strategy for you. And I think I may have mentioned that. Go to the PSF. So if you're in the public service sector, for a lot of people who may be nurses or whatever, and they're working at nonprofits, if you're in that public service sector, if you're teaching at a school that qualifies for this, go to the website, see if they have eligible payments that can help you earn more credits for the payments that you've already made. Look out for that income-driven plan. When they come out with the details on the income-driven plan, even more, see if you're in an income-driven plan now, see if the new one is best for you, if you can switch. If you're deciding on your repayment plan, or you have a child or a cousin or nephew or someone who's deciding on their income-driven plan, then tell them to look into this new one. It's much friendlier. So as like I said, we were gonna go over pull out a few nuggets here or there. I hope you got something out of this. The thing I've gotten out of it is that you got to go beyond the headlines sometimes. There are some things that are going to help a lot of people who might be struggling within this Biden-Harris student loan debt relief program. And so definitely do what you can to if it's you, if it's your family, or if it's someone else that you love and take care of, make sure that they're looking into this program and not just looking at the surface things, but deeper down to see if it benefits them. So we're going to take a time here and answer a few questions that you got that we've received. We're going to start out here. Let's see. Question is, I recently listened to your episode on mortgages. My home value has gone up significantly over the past 3 years. I am looking to do some upgrades and get a home loan. Should I refinance or get a home equity line? Okay, good question. Well, I mean, with interest rates rising like they are now, yeah, so this is a very nuanced answer. I mean, it's got a lot of moving parts to it. So here's what I would say. If you had some increase in your equity in your house and you're looking to try to do some upgrades around the house, refinancing, it depends on what your rate is. I mean, if you have a really great rate, let's say if you refinance during the pandemic or you bought when rates were at 2.5%, 3%, then obviously we don't want to refinance that now. Not at the current rate level. So then what's better? Maybe a home equity loan or home equity line. If these are your options that you're looking at, these are the only two options that you're looking at. You got to think with a home equity line of credit, sometimes it's called HELOC. When interest rates go up, that HELOC is going to adjust. The rate's going to go up. That means your payment's going to go up. So we're still in even though inflation has kind of leveled off a little bit, where we're at this 8.3 annualized clip, and we haven't ascended higher than that the last couple of quarters, it's still very prevalent. And the Fed is still raising rates to combat inflation. And so I wouldn't at this moment go into a variable rate mortgage like a HELOC, HELOC. I wouldn't go into a home equity line of credit because the chances are those rates will continue to rise, meaning that payment will continue to rise. If you go to a home equity loan, you get to go talk to your banker or mortgage person, and you get to say, hey, what is my rate now? What is my payment on X number of dollars, however much you need? And that loan officer will tell you the rate is this, the cost for the loan is this, and it's a fixed term and it's fixed. So that might be a better thing in this rising interest rate environment. Now, some may argue that, hey, if rates go down, that HELOC, the rates are going to drop and your payment will drop as well. But I would tell you, like right now, lock in that whatever that rate is, if it's 5.5, 6.5, whatever that is, make sure it's affordable for you, make sure it's something that you want to do, and go from there. If it's a project that you could be patient on, save up for, I would recommend that before you went and got even a home equity line or a home equity loan or refinance, just because the cost of money has gone up. And if we do hit some type of deep recession, then rates probably going to drop again. I don't know if that's going to happen. No one knows. But if that's a year and a half from now, 2 years from now, once inflation subsides, then maybe it might cost you less to finance that project. Maybe it costs you more. But I would tell you, to answer your question, if it was something that you had to do, you needed to do, you definitely wanted to do, home equity line, probably not so much because of rising interest rate. Home equity loan, more fixed product. If you're okay with the rate and the payment, then that would be probably the better way to go. And you could always refinance that later if, depending on how much rates dropped and if it was advantageous for you. A great question. All right. Next question. I am a young freelancer. How do you suggest I establish a budget? And we're getting a lot of this, a lot of the gig economy. We're getting a lot of young people who are out there, and not say young people, but older people as well, who don't want to work in corporate America, want to do different projects, want to make money in different ways, maybe getting 1099 income. So what I would tell you is, the first thing you need to do is kind of assess what your budget is now. Like, what's your standard of living? Kind of write down all the expenses, or look at your, if you use a credit card, if you use a bank account, you can go in and look at all your transactions, categorize them, see where you're spending your money now. See how much money you typically take in, see how much money you're spending, and then see if you're overspending or if you're spending less. And then, carve out 20 to 25% of your money to go in savings. And, the money that you need to pay taxes, especially if you're freelancing, you need to, depending on how much money you make, you need to sit down with your accountant and figure out how much you need to withhold for taxes off to the side so you can pay your quarterly taxes. And then whatever the rest is, budget it out. See what you can live off on with that. So the first exercise is see where you are standard of living, just to kind of see whether you're overspending or you have the ability to save. Then the next thing is to actually carve in your savings plan and your tax plan, because those are two things that you have to do, and then use your budget to say, can I fit my standard of living within what's remaining? And if you can do that, then that'll be great. I mean, that's the goal of what you want to do, because as a freelancer, you want to probably build in this current environment 6 months to a year of cash. If you go back to my episode 2, which I wish more you would go back and listen to it. Episode 2 is the cash is king episode, and we talk about, so from a freelancer, to give you ultimate flexibility and help you through a deep recession. I would tell you, hey, try to live within your means and save as much cash as possible. Great question. All right, so next question. Thank you for your episode on college goals. Where is the best place to save for my children's college? Yeah, so there are so many different options. You can save in your savings account, save in a mutual fund. There's other different, there's UGMA accounts that you can open up. I mean, so there's different things that you can do. What I found to be the most effective, and I'm not saying this is absolutely right for you, but this is the most effective, what I found for most clients, is to open up a college savings plan, a 529 college savings plan. Now, most states have one. You can just check your state and see which one is available to you. You can go online and open the account. If you don't have an advisor, you can go talk to your advisor if you have one. But look into the college 529 college savings plan. Now, some states have a 529 prepaid college plan, and then they would have a 529 college savings plan. Each state is different, and if you want your child to go to an in-state school, sometimes that prepaid college plan might be something that you need to look at and consider, at least with a portion of it. You're paying a fixed cost, and you get some level of guarantee that no matter what's happening with tuition increases, that your money, your present dollars you put in there, is going to take care of future expenses. Not all states have them. Some states have fumbled the ball on theirs when they've implemented it and gotten rid of it. But it's worth looking into and seeing, okay, so it's still a 529 plan, but it's a prepaid college, so you can look at there. Then the other part is 529 college savings plan, and that's the more variable. You can invest the money, and you're investing it based on your child's age or whatever your investment choices are, and it's more market based, and you can save in a college saving 529 college savings plan. The college savings plan and the 529 money that comes out later on the prepaid side, if they're used for college, is tax free. So there's other kind of things in there that we would have to talk about, that you can talk to your advisor about. But the point is, you save after tax dollars, and as long as those dollars are used for college, you can get those funds to pay for college tax free. So look into that. Not saying it's the absolute best place for you, because again, you need to check with an advisor and consultant, because there are some things that you need to consider. But that would be the place I tell you has been most effective for most of my clients. All right, let's let this be the last question. What has been your biggest challenge being a father? Oh, my biggest challenge of being a father. I've enjoyed my journey as a father. Fatherhood has been, very fulfilling. I've loved my kids. I enjoy them every time we're around. So I would say more of the challenge has been more internal. What I might struggle with as far as being a business owner, at the time being a husband, trying to be a son, and then also trying to be a father as well. I think like most parents, you can lose yourself in that journey, because if you want to be the best parent you can be, you want to be as present as possible, you want to be successful in your marriage, in your business, you want to be successful in your relationships, you want to be, many people have these desires. I mean, I had those desires to be the very best I could be in all of that, and I think sometimes you have to give yourself grace. And my biggest challenge probably has been internally, feeling like I've done those things adequately or where I've fallen short. But because there is a commitment to being a father. Your children didn't ask to be here. They're your responsibility. God has charged them to you, and so there's a tremendous amount of responsibility there, I feel, and I don't see that as a challenge, but how to be everything else and manage everything around that has probably been my biggest challenge. Some areas I failed and how I manage that, and some areas I've learned. I've tried to do like John Maxwell and fail forward. So, but that's been my biggest challenge. So look, I'll just kind of leave it out there. A lot of dads are listening. Send us a note at ask@dadsanddollars.com. Ask, ASK, at dads with the letter N, dollars.com. Send us a note of what's your biggest challenge of being a father. We'll read some of those out on one of our episodes in the future. But thank you guys for joining us. I hope you enjoyed your time here. I hope you got something out of the student loan debt relief as well as the Q&A session we have. Keep the questions coming. Keep the comments coming. I look forward to seeing you on the next episode. Please rate us, review us, share the episode, give us 5 stars. And we will see you next time on Dads and Dollars.
Thank you for joining us for this episode of Dads and Dollars. If you found the information shared today valuable, please share with your friends and family via your social media. If you have a request for a future financial topic for Dads and Dollars, please email us at ask@dadsanddollars.com. For further information on your financial journey, you may purchase The Quest for Financial Independence, 10 areas of your financial planning you should not ignore, by visiting our website, dadsanddollars.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to make a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Asset allocation does not ensure a profit or protect against a loss. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investing involves risk, including possible loss of principal. Guests and their companies are not affiliated with or endorsed by LPL Financial or Intellis Advisory Group. Securities offered through LPL Financial, member FINRA, SIPC. Advisory services offered through Intellis Advisory Group, a registered investment advisor. Intellis Advisory Group and Intellis Wealth Management are separate entities from LPL Financial.